Welcome to Thoughts on the Market. I am Vishy Tirupattur, Global Director of Fixed Income Research, along with my colleagues bringing you a variety of perspectives. I'll be talking about the impact of a rising rate environment across asset classes. It's Tuesday, March 2nd at noon in New York. The conversation over the last few weeks has been squarely on one thing: higher interest rates, particularly higher 10-year interest rates. Why so much conversation? Because the 10-year rate is closely tied to the rates of mortgages, business loans, consumer loans, and so on. So in a sense, it's key to the economy and key to equities, bonds, real estate, commodities, pretty much every risk asset. Since the beginning of the month, 10-year interest rates are up almost 45 basis points and up about 55 basis points if you start counting from the beginning of the year. Considering the history of the last 12 months, this shift higher is noteworthy. Combine tight valuations across risk assets, sprinkle in memories of the 2013 taper tantrum that have not entirely faded, and it is not surprising that the specter of spiking yields portends caution in some quarters as reflected in equity markets last week. However, looking under the hood tells a very different story. Understanding why yields are rising is the more pertinent question, and we argue that higher real yields, along with rising inflation expectations, could create an environment where yields are rising for good reasons. If we examine the composition of the roughly 55 basis point pickup in 10-year yields since the beginning of 2021, only about 20 basis points are from higher inflation expectations and 35 basis points are from higher real yields. In this leg of the economic recovery, our economists expect to see growing evidence of strength in the economic data. Real yields and inflation expectation rise together when investors expect a stronger, more sustained economic recovery. As our macro strategists, Guneet Dhingra and Matthew Hornback argue, the process has already begun, and an improvement in economic data would encourage real yields to participate in the move to higher nominal yields. Of course, the question investors are asking is how risk assets perform when rates are rising along with inflation expectations. Let's take a look back. There have been multiple episodes during 1997 to 1999, 2004 to 2006, and 2016 to 2018 when real yields went up and so did equities. As our chief cross-asset strategist Andrew Sheets notes, historical equity and credit performance have been better when rates are rising than when rates are falling, especially when rates are rising along with inflation expectations as they are doing right now. Andrew also examined multiple recent episodes of higher rates when risk assets fell sharply. But in these cases, they were all in the context of actual or feared policy tightening or they were late in the economic cycle. In contrast, we are clearly in the early part of the economic cycle. The credit market performance in the face of higher rates, particularly higher real rates, is interesting. Excess returns tend to underperform in investment-grade credit with higher real rates, while outperforming in high-yield credit. That syncs up very well with the views of our credit strategists Shrikant Shankaran and Vishwas Patkar, who remain comfortable with a down-in-quality view, with high-yield credit benefiting from lower duration exposure and higher spread cushions. Where could we be wrong? Higher real yields with declining inflation expectations would be associated with weaker performance of risk assets, as would spikes in real yields driven by fears about the removal of Fed accommodation. To be clear, nothing in our expectations of economic recovery or the Fed policy suggests any such outcomes. Therefore, our conviction remains that real yields are set to rise, but only gradually, leaving the reflation trade largely intact. Thanks for listening. If you enjoy the show, please leave us a review on Apple Podcasts and share Thoughts on the Markets with a friend or a colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.